thanks to Sam for joining us today. We're really appreciative you made time for this conference. I know the governor is giving his big speech, Mansion House, tonight, and so I know you need to get back to London. So we really appreciate you took the time to be here with us. I wanted perhaps to start, and let me remind the audience, you will have an opportunity to raise questions, and I will be getting those questions here on my iPad. So please do send your questions. We'll make time for that. Sam, I wanted to start with the B word, and I think this audience here in Brussels would expect us to do so. Brexit, I'm not going to ask you to predict what is going to be the outcome of the current discussions, but let's assume, and it's not a crazy assumption, unfortunately, that there is a no-deal scenario at the end of the road. As a PRA, how are you preparing for that kind of scenario?
Andres, thank you very much, and thank you for having me to this session today. So we decided about 3 years ago that the best approach for us at the Bank of England, including the PRA, was to plan largely on the basis of a disorderly, hard cliff edge Brexit, on the basis that if we plan for that and we got ready for that, we should be okay. For everything else, we might have wasted some effort and some cost. But we thought that was the right thing to do, and I know many firms took the same approach. And the work we did there was pretty significant. First of all, we did a stress test for the UK banks to try and work out whether the annual stress test that we run is tougher than the scenario we think could arise in a disorderly cliff edge Brexit. And in the end, the conclusion we came to was that it was, and therefore that we didn't need to get the banks to raise more capital to accommodate such a scenario. In doing this, of course, we've handed a great stick to the lobby groups to beat us with, because they say, oh gosh, your scenario must be tough, the one in your normal stress test, but we like it that way. So we've done that. We've got a liquidity requirement in place across all of the major banks operating in London, which should sustain them through a very severe dislocation in financial markets. We've done a huge amount of work with all of the firms, including a lot in this room, I guess, and certainly I think including our sponsor to some degree, for the business of making sure that a chunk of their revenues doesn't fall away in the event of a hard exit. We've had all the cross-cutting issues, cleared derivatives and all the rest of it. And then actually for ourselves, we've had a huge project, which is to import all of the law. You'd think we could just copy and paste it, but it turns out, of course, nothing in life is simple. You have to actually do some things to make it operable in the UK. Main message to all of you is that is all done. Right. That was all geared to a kind of end March timeline. So actually, we've been in a quieter mode for these last few months because the heat of the activity is largely done. Now, it's not a complete solution, but I think the risks, the financial stability risks around such an event, we have, at this point, done everything we can to mitigate them, and you can do quite a lot. It's not complete, but you can do quite a lot to mitigate those risks.
And you're happy and comfortable with the preparations that the private sector has been doing?
Well, happy and comfortable are two words that never come out of the mouth of the regulator.
Okay, that's fair.
So I wouldn't want to go that far.
Right.
But yeah, I think, to be honest, I think people have done a really pretty good job. I mean, as with all of these undertakings, some firms are better than others, but the firms are basically there in terms of having set up the operations they need to set up,
right,
or using core processes, which is more common for the insurers to move customers from A to B. There is a bit of an outstanding issue around the pace at which EU27 clients are repapering and properly onboarding with the new EU27 entities. We need that to carry on. But in that respect, actually, this extra window that we've had between the end of March and potentially Halloween, actually it's been quite helpful because people are moving more. So even that piece is improving through time.
Right. And from your perspective, preparations for UK banks operating in the continent?
So I think all of the UK-based entities, including UK banks, as you would think of them, but also a lot of third-country firms who are currently based in the UK. Yeah, I think
we're using London as their passport
who've been using the passport. Basically, everyone's done what they need to do in terms of setting up the new entities. Yeah. They're all operable. Yeah. Now, that is not to say that in the event of a cliff edge exit, we may not have some disruption. And the reason that is still possible is basically twofold. One is, as I said, despite the fact that probably the probability of a hard exit, I would say, has increased in recent months. It certainly hasn't decreased. financial markets are still not betting on that being the outcome.
Right.
And consistent with that, operationally, many clients are saying, I've got more important things to do than to repaper to your Paris entity or Frankfurt entity.
Right.
And I do think that there's a risk, therefore, that some clients are surprised and they're trying to repaper at high speed in a cliff edge situation. The second factor which could make that dangerous is at the UK end, on all of these cross-cutting issues, like cleared derivatives is the most prominent one, and on that issue there is a UK-wide fix, albeit temporary one. On all of the rest of the issues, and there's a long list, we've got a pretty complete fix at the UK end. At the EU 27 end, there's a kind of patchwork of different solutions in different jurisdictions, and it's great that jurisdictions have done that. But you can see a world in which patchwork comes together with a lot of people trying to repaper and then on board, which is, of course, a further process at high speed in the middle of a significant financial market dislocation. I think that could be a bit tricky.
Yeah. Well, we'll see. Let's assume Brexit happens, and happens in the way we just described. What is your thinking about the regulatory framework in the UK going forward? Certainly, some people have raised issues about, will the UK make that jurisdiction more attractive through regulation? I mean, what's your take on what will be on day 2, let's say, the regulatory framework in the UK, and how are you thinking of, if you get a blank piece of paper to redesign that framework?
So that's an important if. I think there's two forks in the road. The first fork in the road, and this is going to be for government and parliament to decide, but we'll offer some views in it, is does the government wish to cleave very close to the EU 27 rulebook for reasons of market access? And if the government chooses that path, then in a way your question falls away. That path, by the way, I think is fine as long as we're not a rule taker. But I think being a rule taker when we're trying to oversee a financial system 10 times GDP would be a terrible idea. But let's say we're not on that path. We're in a path where there is the question that you raise does arise. Basically, we have two views. One is, depends what you mean by attractive. We see no world in which it makes any sense at all for us to reduce the stringency of the financial regulation that we have in the UK. We should remind ourselves it's only 10 years since the biggest bank in the world went bust in the UK, and we do not want to see that again. So there is no world in which...
And you're happy with that level of
I think we've
that you have achieved as of today?
Yes, I mean, look, there's no such thing as a total stasis in our world, as you know, but we are through the period when we are making massive reforms, tripling bank capital, ring fencing went in on the 1st of January. So we're through that phase. And we're kind of happy with basically where it is now. We want to keep it roughly where it is now. Now, there are bits of the regime that are dynamic, the counter-cyclical buffer and things like that. Basically, we're happy with the level now. So we want to keep that. The second part, though, does go to your question, is there will be a question for government and parliament about what style of regulation they want to adopt in the UK in this scenario that we are now discussing. And our view on that is that you can think of the way in which financial regulation has been made in the UK as along a spectrum. So there's a Financial Services and Markets Act 2000. That basically has the objectives for the regulator up in regulation, and everything else is left to the regulator. That's at one end of the spectrum. At the other end of the spectrum is how we legislate and regulate within the EU 28. Solvency II would be a great example, where there's much, much more detail up in legislation. And then in the middle, we have, in recent years in UK, the ring fencing regime and the senior managers regime, which they're closer to the British model, but they're not all the way back to this model from 2000. And our view is basically, if we were outside the EU, we should adopt one of those more British ways of making regulation.
Towards that end.
The reason for that is simple, which is that one of the main reasons there's so much detail in legislation within the EU 28 is we are attempting to drive convergence across different countries. And if that reason itself falls away, I think you can go back to a more dynamic and responsive way of rulemaking, but one that is as stringent as it is today.
Right, which in a way is closer to the US model as well.
Yes, there's some differences, but it is the common law base, of course, leads you in the same direction.
Right. You mentioned ring fencing as part of your answer, and that probably takes us to a whole set of issues about market fragmentation, where we are. So IIF has been looking at this issue very closely. We have put out a recent report on it. We welcome the FSB report on market fragmentation. From the perspective of 10 years or more of very detailed rulemaking and really transforming the the financial services regulatory framework, with the idea of creating resilience in the global financial sector, but also maintaining a global dynamic financial sector. Growing concerns about where we are ending up, and that is perhaps in a more fragmented world. And that is perhaps anchored on the notion that you need to ensure that there are sufficient resources at the local level. The firms live internationally, but they die nationally, et cetera. Give us your take, given that the PRA has established a ring fencing framework in your jurisdictions, but going forward, collaboration, coordination with foreign regulators, do we have, can we expect that that collaboration will improve, or do we need to rely on structural measures to ensure that those resources are maintained at the national level?
So I see a very clear distinction here between how we think about retail activity, both for banking and insurance, and wholesale activity. So retail, in my opinion, is naturally local. And I think that's true for business reasons, it's true for regulatory reasons, and it's certainly true for political reasons. And I think in relation to retail, it's far better to recognize that upfront in benign times and have that done locally, by which I mean in subsidiaries, or for things that are particularly sensitive, it could even be in ring-fenced subsidiaries, which is what we've done effectively for current accounts in the UK. And I think it's better just to recognize that and be realistic about it, because if you don't, the reality is when you get into a stress, regulators are going to ring-fence that activity, either of their own accord or under severe political pressure. And that twist in the shape of the financial system in the middle of the stress is itself a dangerous and, of course, a very costly thing to do. So for retail, I think it's best just to acknowledge that. I'm not saying it's a good thing or a bad thing, but I think it's just realistic. That's the path we're on.
So you would say going forward that probably needs to be the model.
I think for retail, that's my view. Everyone will form their own view. Of course, you know, there's an interesting question here within Europe about what is a border. So within Europe, I'm talking there about the perimeter outside the EU 28.
Okay.
That's for retail. For wholesale, I take a completely different view, and we also do institutionally, and it's reflected in the approach that we take, which is we think the wholesale is naturally cross-border. Not only that it is naturally cross-border in the sense that that's efficient from a business point of view, it's also naturally cross-border in many cases from a regulatory point of view, in the sense that if you ring-fence a chunk of, say, a global trading bank, one slice of it, I think the truth is you delude yourself if you think that that gives you the ability to deal with that piece of that institution by itself. I just do not think it's true, given the multiple ways in which those institutions are interconnected across borders. So it's sort of the opposite. I think it's better to recognize that reality, not to fool yourself that ring fencing is going to work, not to try and do that in a stress, and to be open. But that relies on, crucially, proper information sharing between regulators, proper visibility across the firm, proper supervisory cooperation, and also knowing who is doing what. And our philosophy is basically, if you have all of those things, then you can branch, even at scale, in wholesale.
Right. And what's your assessment today of those level of cooperation, information sharing?
Well, look, I think they are pretty good, but the tide seems to be against this way of thinking. And my sense in my seat is that, you know, we're not yet an outlier, but we are increasingly becoming at the edge of the pack in terms of the extent to which we are open to approaching wholesale business in that way. Having said that, as a practical matter, in terms of the level of cooperation we have with colleagues, for instance, from the Fed, that all works fine. So that's okay. It's more that things emerging in the policy sphere seem to be pushing us in a different path.
Right. And perhaps one of the areas where this gets tested, it's on the discussions around internal TLAC, for example, and the range that was defined by the FSB. I do recall that you sort of made an international appeal for, well, there are two possibilities. You can go to either side of the range, but that the UK would be willing to go to the lower bound of the range, provided that was the same with your major international counterparts. That didn't happen. What happened?
Well, it's a perfect example of exactly what we're talking about here. So we took the view in effect, for retail and for our ring-fence banks, 90 seems like the place to rest. But for other types of subsidiary, or the wholesale ones, we'd be happy to be in the range of 75 to 90, and we'd be happy to be at 75 if we've got all the sorts of things I was just talking about. But as you say, the debate hasn't moved in that direction, and in fact, in exactly 7 days' time, all of those subsidiaries in the UK will have to be at 90 because we lost that debate in the CRR2 context. So, look, you win some, you lose some, but that's a really good example of when I say we seem to be at one edge of this debate. I mean, I feel it in places like that.
Is there a way to correct that? Do you see any?
Well, people should follow our example. But I'm waiting and seeing.
And I should add that Governor Quarles in the U.S. made exactly the same appeal in Washington. But I mean, and that's one of the issues that we have raised at the IIF as, going forward. Let's switch gears and talk about, you obviously regulate both banking and insurance companies, and you gave a very interesting speech about scanning the horizon, where there are issues that are cross-sectoral that merit the attention of the prudential supervisor. Tell us a bit about how you're scanning that horizon, the kind of issues that you are identifying there.
So, look, I think it's a natural thing that happens in our line of business. People in the room will know that, we've had an enormous financial crisis, we've had a huge reform period, and then as that settles, the system is going to try and optimize to the new regulatory shape. Some of that is fine, some of that is reg arb, some of it is somewhere in between, and where it's reg arb or in between, we need to push it back into the fine box. We'll get rid of it. And we do see quite a lot of activity of that kind going on. We're putting more and more of our own resources into scanning for that sorts of activity, because it will not always be the case that an individual line supervisor will obviously be able to see that for one firm. And the example you give is an interesting one. So one of the areas we look at is, is activity herding across the border from banking into insurance or from insurance into banking? And if it is herding, is that herding because the risk in question is better managed on the other side of the border, or is it happening because regulation on one side of the border missed something that's been captured on the other? And surprise, surprise, quite often it's the latter. And where that is the case, obviously we need to nail it.
Are there any specific examples, any areas that are not of concern, but at least attention to you?
Well, one thing that we do keep an eye on is, and as you say, I've given a really very long and I thought very interesting, but views might differ, speech on this question, which people can refer to if they want to, is about leverage. In the sense of, like all metrics, the leverage ratio metric that we've adopted is not perfect. And there are some slight oddities in bits of it. And one of the bits that I think we need to have an eye to is the really very sharply differing treatment in the exposure measure of repo and collateral swaps, which seem to me to be fairly close cousins in terms of the type of risk that a firm will be taking on if the collateral is of a high quality. And so we need to keep an eye on, well, what will firms' leverage ratio be, for instance, if we treated collateral swaps in the same way as repo, and questions of that kind. So that's the kind of stuff that we're looking at.
But not issues that you would take back to the Basel Committee to re-examine? And
honestly, I just think it's unrealistic.
Right.
And wherever you land is not going to be perfect. So I think we're now into more of a supervisory phase, which is, okay, we don't want to go and relitigate this thing. But, you know, for a particular firm, if you happen to have some interesting results when we look at it that way, what's going on? You know, are your risk managers aware of that? What kind of risk are we running? I think that's more the way we'll handle it.
Right. And I'll use that to get to the Basel Committee. You don't see the Basel Committee getting into additional rulemaking at this stage?
Look, I don't. We're through that kind of big rulemaking phase for sure, and that is natural, and we're more into a kind of evaluation phase. The one area that which we might come on to at some point that is a bit different is the area around operational resilience, where I think there is a gap in the framework, and Basel is certainly talking about it, and we're doing a lot in the UK.
Yeah. Well, tell us about that, because the UK has certainly been in the forefront of this issue. I mean, you issued a really interesting discussion paper that really goes beyond cyber resilience, which obviously is a topic that every single supervisor has been addressing. But you had a very interesting and focused approach to operational resilience. What are you trying to achieve there?
So we made the observation about 2 years ago that we had a huge amount of activity going on in supervision and quite a lot in rulemaking too around this set of issues. So we had cyber penetration testing, outsourcing reviews, an approach to how we deal with the cloud, all this kind of stuff. But if you look, and I think it's all helpful, but if you kind of looked up above that, what is the equivalent of 1 in 200 in Solvency II on capital for operational resilience? Or what's the equivalent of the Basel stack?
Right.
And basically our assessment was that there certainly isn't in the UK, and to my knowledge there's not internationally, a proper framework. Another way to articulate the question is, when firms say to us, how operationally resilient do you want us to be? Well, we say something like very, right? It's not a very satisfactory response. So we therefore put out a discussion paper, the one you mentioned, and this triggered, by UK standards, a very large number of responses. That usually means people hate it and they want to argue about it. Actually, in this case, I think people are enthusiastic. And there may be two reasons for that. One is that the construct in that paper is absolutely bone simple, has only three bits. One is firms should identify what are the key business services they are providing. Secondly, they should enunciate what is their impact tolerance, by which we mean what is usually the amount of time, it might be a volume of activity, that they are prepared to see that activity go out for. And third, which is the only thing that gives meaning to the second, how have they assured themselves in good times that they can indeed meet those impact tolerances, which you could think of as kind of using what we're all used to as fire drills, but in more of a stress testing kind of way. So we tested it for this and that, and here's a super severe one, which we acknowledge would breach our tolerance. That's the concept, very simple. Second reason I think perhaps it was popular was that we don't claim to have special expertise in this space, and what we did was look out into the industry, say who's got the best practice out there, and took that into the paper. Last point on this, which I think will be of relevance to you, Andres, is there may well be, I think, quite a big difference between financial resilience and operational resilience in the following way. That the whole point of what we do on capital and liquidity is our assessment that when things go badly wrong, some of the costs of firm failure are externalized and borne by others. So we make firms hold more capital and or liquidity than they would on average left to their own devices to try and internalize those costs. If you come across into the operational resilience space, it's not clear to me that we're going to need to set regulatory impact tolerances which are binding, because I think it may often be the case, or indeed always the case, and certainly today in my experience it has always been the case, that there are really very large and very significant private costs from having a big operational problem before it becomes a safety and soundness issue. So it may be that even if we do have our own tolerances, that at least from the prudential point of view, they're actually outside what firms want to set for themselves.
And you're absolutely right. This has been a very welcome development. The IIF, together with the FMA, is working hard on producing a set of principles that we hope to engage with the official sector on this. Let me check about questions, which actually we have many. Well, this was expected. The L word, Libra, is the recently announced initiative by Facebook. Do you have any comments about those developments?
It's the issue of the day. I probably shouldn't say too much as we're just starting on it, but I think I would just make two comments. One is that we cannot be in a position where we are frightened of or negative about innovation as a starting point. I think that is a road that we do not want to be on. So we should approach such things in a positive frame of mind. However, my second point is this. It does seem clear that something like this could be very important from a regulatory point of view, and we will need to work through, if the plans go ahead as envisaged, what the regulatory treatment of such a new asset class would be, and is it an investment fund, is it deposits that are being taken, numerous questions of those kinds. And I think there is a little bit of a cautionary tale here from the way that separate phenomena developed in China, where the authorities have had, in fact, to pull back a bit where some of the technologies had got to, and the speed with which that move was very fast. So I think that's the agenda for us regulators in looking at it.
Right, and it's about the scale, right, with which this would be implemented. You're still part of the European Union, and the question comes from the audience about further consolidation. But let's just talk about the UK sector. Further consolidation is needed, or are you happy with how the industry is structured right now?
So, look, my view on that is we're not running the banking sector,
Right.
nor the insurance sector. It's our job to set some tram lines.
Nor doing industrial policy.
Yeah, and then the firms are privately owned, or in some cases mutually owned. You know, if they want to put themselves together or take themselves apart, we have both those things going on in our jurisdiction.
Right.
That's fine, as long as they stay within the tram lines. The one rider to that is that we happen to have, unusually amongst prudential regulators, a secondary competition objective.
Yes.
Now, there's also a competition authority in the UK, but we do therefore have an interest of a secondary kind in whether the way that the shape of the industry is developing, might be positive or negative competition. The main thing we've done there to date is we have done a lot of work to make sure that new entrants can come into the banking
Right.
sector, which has pros and cons, but it's definitely a positive from a competition point of view. And we've authorized 17 new banks in the last 6 years in the UK. Actual banks, we've got a higher number of authorizations, but actual
Right,
new
right.
banks, as you'd recognize them, which is quite a lot.
And the experience so far with those new entrants?
Well, some of them have made some inroads into the markets,
Okay.
many different models.
Yeah.
It is striking so far that no one has really broken through into being a big challenger to the other banks. One model, though, that I do have an eye to is some of these digital banks, which are making bigger inroads than we've seen to date into the personal current account market, which has typically been very sticky in the UK.
Right, right. As a positive development and beneficial for the customer as well.
Well, I guess if people are buying it, they must like it.
Yeah.
So I say,
Yeah. Well, I know you need to get back to London, and we want to be respectful of that. But we really appreciate that you took the time to be here with us. We hope to have you again at our next event. So thank you again. Please join me in thanking.
Great. Thank you. Thank you very much.